Hello and welcome to another explainer on investment basics. I'm Majid Butt, and as an accountant, software programmer, and investment researcher, I love digging into the nuts and bolts of how businesses really work. Today we're tackling the engine room of the economy, industrial materials. We're talking about the companies that literally build our world, from steel beams to jet engines. It's a classic old economy sector, but you'll see it can be a real minefield for investors.
And that brings us to the big question, the paradox that's at the heart of this entire sector. How is it possible that the very companies building our cities, our cars, our planes, so often end up just destroying investor capital? These are giants, the makers of absolutely essential stuff. So why do their stocks so often leave investors with nothing to show for it? That is the core problem we are going to dissect today.
But don't worry, it's not all doom and gloom. My goal here is to show you exactly how to navigate this tricky sector. We're going to break down the key challenges, but more importantly, we're going to focus on the hallmarks of success. And you'll definitely want to stick around because at the very end, I'm going to give you a complete, comprehensive investor's checklist that you can use for your own research. All right, let's get into it.
Okay, first things first, we absolutely have to understand the biggest monster lurking in this sector, and that is cyclicality. Honestly, this one single factor explains more about the performance of these companies than pretty much anything else. You know, not all industrial companies are created equal. It helps to think of them in two big buckets. On one side, you've got your basic materials producers. Think commodity steel, basic chemicals, or aluminum. Their product is, well, it's a commodity. It's undifferentiated, which means they are price takers. They have almost no control over what the market will pay. Then, on the other side, you have the makers of value-added goods. We're talking complex, specialized products like a General Electric jet engine. Because they solve a very specific, difficult problem, they become price makers. They can actually command a premium price. And believe me, that distinction is absolutely crucial.
So, what drives the fortunes of both of these groups? It all comes down to the business cycle. You know how it goes. The economy expands, demand for everything is high, and those factories are just humming along running 24/7. But then, inevitably, the economy slows down, demand dries up, and those exact same factories suddenly fall quiet. Industrial companies literally live and die by this rhythm.
And this brings us to what I think is the best analogy for this sector. It's called the bullwhip effect. I want you to picture someone holding a long bullwhip. A tiny little flick of the wrist, and that flick represents a small change in the overall economy. It creates this massive, violent crack at the other end of the whip. Well, that violent crack, that's the sales and profits of an industrial company.
And this chart, wow, it shows the bullwhip effect perfectly. Just look at that first bar representing US GDP growth. See how it's relatively small, pretty steady? Now compare that to International Paper's sales. During an economic boom, their sales growth just explodes upwards. But during a bust, it absolutely plunges. It's that magnification, that amplification at both ends of the cycle that makes this such a wild and dangerous ride for investors.
So why is this swing so incredibly dangerous? Well, it comes down to two words: high fixed costs. It costs billions of dollars to build and maintain a steel mill or a modern factory. Now, when sales are booming, those costs get covered easily, and every extra sale is almost pure profit dropping to the bottom line. That's called operating leverage, and let me tell you, it feels fantastic on the way up. But when sales fall, those massive costs, they don't go away. They become a concrete anchor, dragging the company's profits and sometimes the entire business straight underwater.
So, if the cycle is unavoidable, and frankly often brutal, how can an investor possibly succeed here? What's the secret? The answer is to find companies that have managed to dig a protective barrier around their business, what we investors call an economic moat.
The legendary investor Peter Lynch, he had a real knack for this. He famously loved finding great companies in lousy industries. And the logic is just so simple and powerful. A truly durable, well-defended business can thrive even when its surroundings are hostile. For us, in the industrial sector, that means finding a company that can protect its profits from both the crazy economic cycle and from ferocious competition.
And the good news is, these companies do exist. They're out there. I mean, think of a company like 3M, which is just famous for its constant innovation. Or Pitney Bowes, which for decades dominated the mail meter market. Gentex, a key supplier of auto-dimming mirrors for cars. Or even the defense giants like General Dynamics and United Technologies. Each and every one of these firms figured out how to carve out a defensible, profitable niche in a really tough industry.
So how exactly do they build these defenses? Well, their moats usually come from a few key sources. For companies like 3M and Gentex, it's a fortress of patents protecting their technology. For a company like Pitney Bowes, it was all about creating incredibly high switching costs. It was just too much of a pain for their customers to leave. And for firms like General Dynamics and UTX, the advantage comes from operating in highly concentrated industries, like defense and aerospace, where there are only a few major players. These advantages create a kind of stability that is just incredibly rare in this sector.
Okay, so we know we're looking for these great companies with deep, wide moats. But how do we spot them in the wild? How do we use actual data to find them? Let's get practical now and look at the numbers that really separate the winners from the losers.
Now here's an absolutely crucial insight. In a world of fierce price competition, you just can't rely on finding companies with high profit margins. For most of these businesses, margins are razor thin. They just don't exist. The true hallmark of a great industrial company isn't how much profit it makes per sale, but how efficiently it uses its assets, its expensive factories and machinery, to generate those sales in the first place. It's all about ruthless efficiency.
The key metric we use to measure this is called total asset turnover, or TATO for short. It's a fancy-sounding name, but the ratio itself is actually super simple. You just take a company's annual sales and divide it by its total assets. The question it answers is really powerful. For every single dollar the company has tied up in assets, how many dollars of sales does it manage to squeeze out each year?
And here's a simple rule of thumb you can just stick in your back pocket. A TTO ratio above 1.0 is a fantastic sign for an industrial company. It means the business is generating more than $1 in sales for every single dollar of assets it employs. It's a really clear signal that you're looking at a highly efficient operator.
And this table right here, it just illustrates the payoff perfectly. The proof is in the pudding. We're using a similar metric here called fixed asset turnover, which just focuses on the core machinery and factories. Now look at those top two rows, the wide moat companies, UTX and General Dynamics. Their FATO ratios are way up there, at 6.2 and 7.7. And their returns for shareholders, a fantastic 17% and an incredible 31% per year. Now contrast that with the commodity players on the bottom, Dow and DuPont. Their FATO ratios are low, and their returns are just stuck in the single digits. The lesson could not be more clear. Efficiency directly translates to long-term shareholder returns.
Okay, but just as important as knowing what to look for is knowing what to avoid. You have to understand that this sector is absolutely filled with what we call value traps. These are companies that look cheap on the surface, but they're cheap for a very, very good reason. So let's cover the biggest red flags you need to watch out for. When you're doing your research, you need to scrutinize three main areas like a hawk. Number one is debt. A crippling debt load can be absolutely fatal in a downturn. Number two, you have to look for hidden liabilities, like massive underfunded pension plans. And number three, you have to check the company's M&A history for large, poorly planned, value-destroying acquisitions. I'm telling you, any one of these can sink an otherwise decent company. And for debt, here's another useful number to keep in mind. A debt-to-capital ratio that creeps above 40%, that should really raise your eyebrows. Remember that bullwhip effect we talked about? Well, when sales plunge during a recession, a company with a huge pile of debt might not be able to make its interest payments. Debt is like pouring gasoline on that cyclical fire. And history is just littered with examples of this. International Harvester's staggering 86% debt-to-capital ratio, it pushed them into a spectacular bankruptcy. Dow's massive acquisition of Union Carbide, it piled on debt right before a downturn, completely distracting management and destroying shareholder value. And a solid company like Deere saw its pension plan become underfunded by nearly $2 billion, a huge liability that directly reduced the value belonging to its shareholders. These are not theoretical risks, folks. They are absolute company killers. All right, we've covered a lot of ground. We've talked about the trap of cyclicality, the solution of finding economic moats, and the key metrics and red flags to watch for. So now, as promised, let's pull all of this together into a clear, actionable investor's checklist.
Okay, let's walk through this checklist, point by point. First up, this is a traditional old economy sector with high fixed costs. Always, always remember that. High fixed costs are just the name of the game here. Second, companies are either commodity producers, price takers, or value-added goods makers, price makers. You have to know which type of business you're looking at. It changes everything. Third, sales and profits are highly sensitive to the business cycle. Never forget that bullwhip effect. You have to expect volatility. It comes with the territory. And fourth, competitive advantages are rare. Look for low-cost producers like Nucor, or firms in niche/concentrated industries. Basically, Understand that true economic moats are the exception, not the rule. You are hunting for those rare gems.
And now for the second half of our checklist. Point 5. Only the most efficient producers with low debt will survive a downturn. In this sector, it's truly survival of the fittest. Only the best operators with clean balance sheets are going to thrive. 6. Use asset turnover ratios, TATO and FATO, to measure a firm's efficiency. These are the right tools for the job. They're your best quantitative guide to finding those efficient operators we've been talking about. 7. Watch out for too much debt, large underfunded pensions, and big acquisitions. You have to actively screen for these major red flags. Put them on your deal breaker list. And finally, point 8. Focus on companies chasing sustainable profits, not just market share. Look for a management team that's rational, patient, and focused on the long-term health of the business, not one that recklessly chases growth at any cost.
So there you have it. That's a complete framework for analyzing this challenging but absolutely essential sector. The industrial world is full of really tough businesses, but as we've seen, it also hides some truly exceptional long-term investments. The only question left is, now that you have this checklist in hand, where are you going to start looking?